Many business owners use pass-through tax entities for one reason and one reason only: tax savings. We'll go through that process right now. I'm Mitch Greene, a partner at Kramer Greene for over 30 years, and I've been working with businesses in various industries, including healthcare, protect their businesses from unforeseen legal circumstances. If you're trying to protect your assets or your business, I will help you create a playbook that allows you to do so. So give me a call today to set up a complimentary consultation, and I will walk you through the process that will allow you to do so. In each video, I share insightful, actionable information that will protect your assets, wealth, or business. So check out the rest of my videos on my site or my channel. In this video, we're going to discuss everything that you need to know about pass-through entity tax. If you're a small business owner or partner in a partnership, you're probably familiar with the concept of a pass-through tax entity. However, if you're not, you may be scratching your head as to what exactly does that mean. Simply put, a pass-through entity is a business structure where the profits and losses pass through directly to the owners and are reported on their individual income tax returns. That means that the entity itself is not subject to taxation, but rather the profits and losses of the entity pass through to you, the owner of the business. So how does pass-through entity taxation actually work? Well, when it comes to taxation, pass-through entities are categorized into three main types: a sole proprietorship, partnerships, and S corporations. In a sole proprietorship, the business is typically operated by a single individual. The owner reports their business income, expenses on their Schedule C of their individual tax return. No separate tax return is prepared for the entity itself. However, in a partnership, there are multiple owners. In that case, while a partnership return is filed, the profits and losses of the partnership are not reported at the partnership level, but instead pass through to the individual partners, typically based upon their partnership interests. While the partnership files a tax return, IRS Form 1065, the profits and losses of the partnership flow through to the partners and are reported on the individual partners' tax returns. Now, in an S corporation, it provides the best of both worlds. It provides the benefits of a corporation as well as the tax benefits of a partnership, in that the profits and losses of the S corporation are not taxed at the entity level, but instead flow through to the shareholder level and are taxed on their individual income tax returns. One of the main advantages of pass-through entity taxation is that the profits of the business are only taxed once at the individual owner level. In a typical corporation, known as a C corporation, the profits of the corporation are taxed at the corporate level. The corporation files its own tax return and pays tax on the corporate profits. Then, if the corporation makes dividend distributions to the shareholders, those dividend distributions are taxed once again at the individual shareholder level. So you have double taxation, once at the corporate level, and then a second time through the payment of dividends at the individual shareholder level. In other words, that's paying tax twice. And while most of us don't like to pay tax even once, none of us like to pay tax twice. The main question you really have to ask yourself is that if you're not using a pass-through entity for taxation, how much are you really making? Because at the end of the day, it's not how much you make, it's how much you keep. If you have questions surrounding your business legal needs, give us a call, set up an appointment today, and take the first step in protecting your business and financial future.